Joining me now is Lyn Alden, founder of Lyn Alden Investment Strategy. Thanks for being with us, Lyn.
Happy to be here. Thanks for having me.
Now, you said before that in terms of commodities, you're cautious on discretionary and cyclical type commodities when manufacturing is in decline. And we're seeing industrial recessions, and we can argue that in China, the Eurozone, and even the US right now. So, what is your general view of commodities and the so-called capex type commodities, as you call them?
Well, so I'm generally bullish on commodities with a multi-year view, but basically the ones that are more tied to, like you said, capex, basically ones that are involved in the manufacturing process, the ones that are more cyclical, I'm less excited about with, say, a 3 to 6 month view, and I've been sticking to some of the other somewhat more defensive commodities. So it's like basically a matter of time frame management. I think the overall risk reward of most capex more of a sign that we're entering another period of economic reacceleration. But until then, I think we're probably going to see somewhat choppy action out of them.
Speaking of reacceleration, we have seen the CRB index up about, let's call it 10% in the last month, and oil is up around 20% from its recent trough. Would you say that we're seeing a reacceleration in inflation and that commodities and commodity producers could do well in that environment, or will Jay Powell, whom we heard from yesterday, will he prevail, and will the economic cycle prevail? And there's a bit more pain to come.
So I think around the margins, OpEx commodities are a little bit more attractive than CapEx commodities right now. So that's things like oil that we use on an ongoing basis, whether or not we're building or not. And if you look back at most recessions, we often think of oil crashing during recessions, but it often doesn't. I mean, the obviously the 2020 event did. That was an unusual one. The 2009 recession was also a very large recession that also took place right after a very big capex cycle. So we had plenty of supply and then demand was hurt. But in a typical recession, oil demand doesn't necessarily go down much at all. And prices tend to be kind of choppy instead of downward. So I do think that there's more reason to be constructive on energy types of commodities. We're still kind of in a similar situation where the next 6 months is quite unclear if we enter, if Powell does tighten more aggressively and hurts some of the commercial real estate more than it already has and kind of impair parts of the economy, that could continue to be a drag on oil prices. But it's not necessarily my base case. I think, I'm bullish enough on energy long term that I'm willing to go through any sort of volatility in the next few months. I think it's a pretty constructive place.
So, whenever we do see manufacturing return and demand for commodities start to rise, let's call it a few quarters for argument's sake, do you think copper is going to be a big beneficiary? Are you bullish there? You said you're generally bullish commodities long term, and do you buy into this argument that there's going to be a bigger and bigger deficit as we go further out in the decade, as we transition slowly or quickly to a more green environment and energy?
Yeah, I think there's a few different layers to the question. And so even without any sort of transition, just the sheer usefulness of copper within the current economic environment, I think as countries like India and others get more copperized, for lack of a better word, I think that'll represent marginal demand. So for example, I think, China's overall copper consumption is not going to be on the same trajectory that it was before, but that'll get replaced by India and some other countries. So I do think the overall outlook for copper is very attractive relative to the relatively tight supply picture looking ahead. And then when we add on top of that various attempts to diversify our change, our energy sources, those energy sources are also more grid intensive. That means more and more kind of grid building and making grids more robust. Basically, across the whole spectrum, regardless of which types of technologies win over other, the answer almost always is more copper. Um, and they take there's no like equivalent like for shale oil and copper. So in the oil market, there's certain projects that are, they take many years to bring online. Whereas shale has been this kind of quick source of new production around the margins. Whereas with copper, you don't really see anything like that. Basically, all these projects are long life cycle to varying degrees, and ore grades generally have a downward slope. And so I do think that there's going to be, a tightness in that supply demand equation for, years ahead. I mean, for the foreseeable, like investing time frame, outside of, potential recessions briefly.
Lynn, you said your preferred way to invest in commodities is through producers. What specific attributes do you look for when you're analyzing companies?
Yeah, so I mean, it depends on the commodity. I mean, certain, gold, silver, and uranium, I think I like to have exposure to the underlying. But for energy and copper, for basically oil, gas, and copper, I tend to stick to producers. And personally, because I'm not a specialist that wants to go down and study the geology of every different company, I focus on the medium and large types of companies. So instead of kind of going for every bit of outperformance, I go more for what is, I think, well positioned to catch the whole trend. And so I tend to like low decline rate, large reserve, low cost production companies that I can hold for many, many years. Because the challenge with some of those weaker companies is that they can give you very explosive returns in a good environment, but then they often have trouble even surviving through the bad environment. And kind of the key is just if you can just stay there, you can eventually catch the next cycle. So I tend to err towards the safer end of the spectrum.
Now, as far as uranium, you said that you went bullish on it in October of 2020 after doing a deep dive, and your timing was interesting because if you use Cameco as a proxy, for example, it's pretty well tripled since then, and the price of uranium has gone up. What is your overview and your bull case on uranium right now?
Yeah, so back then it was interesting because that was before Sprott took over the uranium fund, and the Uranium Participation Corporation back then was trading at a 20% discount to NAV. So uranium was something like $30, but then you could buy it at 80 cents on the dollar. And so the underlying uranium has been an interesting trade as well as the miners. The general thesis there is that kind of similar to what we talked about before of just mainly supply and demand. So the world consumes more uranium in its current reactor fleet than it produces from mines every year. And that difference is made up by secondary market sources. So, a lot of uranium in the past went towards militarization, making nuclear bombs. And as a lot of those bombs and stockpiles were decommissioned, that brought more potential fuel to the energy production side. And so we've been in this period where we're consuming more than they're producing, but we have this kind of relatively large and opaque market to fill that gap. And the general thesis is that, while we can't know exactly how big that secondary market is, we have somewhat tight estimates on the range of how big it could be. And by most estimates, there's not a lot of spare capacity there. In addition, a lot of utility operators are pretty low in terms of inventory. They're kind of due for another long-term contracting cycle, and so basically we've underinvested arguably in uranium production, and especially if we talked about in one of the prior questions about energy transitions. Nuclear still remains one of the most optimal energy sources. We see it a lot right now. Developing countries have not been shy to go that route. So China, India, certain Middle Eastern countries. While in the West we've kind of pulled back from nuclear, some of these other countries have not. And so I think that in the years and decades ahead, we'll have a steadily increasing number of nuclear reactors, and that's going to need more supply. And so I think we're due for a. I think this bull cycle still has further to run.
You mentioned Sprott. Is that your preferred way to get exposure to uranium and uranium companies, their ETF?
I think the risk reward in this case is more attractive than some of the producers, but I think producers are a way to play it as well. I just think that you have to be even more careful with these than you do with energy, like oil and gas types of producers, because the vast majority of them are fairly low quality, and many of them won't even produce in an investable time frame. It ends up being more of like a speculation for future development. So, in general, I think there's multiple ways to play it, but just owning uranium is an interesting risk reward when looking out a few years.
All right, let's shift over to gold. You said that historically, gold actually tends to track and move with money supply or M2, and less so inflation, which and we actually talked to Jay Van Sciver, head of industrials over at Hedgeye, and he was saying that there's this concept that gold is an inflation hedge, but it's not always the case. So sticking with M2, it's sitting at a 60-year low. So how would you characterize gold's relationship with the money supply right now?
Well, so I think it depends on the time frame you look at. And so when you look at inflation in general, the challenging thing is that CPI, because it's a basket of different goods, and when you also have the fact that people, they filter out things that get too expensive. So, for example, if ribeye spikes in price, people will switch over to ground beef, and then the basket adjusts for this new reality. And then if ground beef gets too expensive and people shift more towards poultry, that'll reflect that as well. And so, when you look at a long-term study of the price at which different things go up compared to money supply or CPI, you get kind of a spectrum based on scarcity. So the truly scarce things like waterfront property or fine art from long dead artists, the prices of those things tend to go up as quickly as the broad money supply, which is roughly as we'd expect. And then we look at kind of the next layer down. We look at things that are not completely finite, but that are scarce and relatively energy intensive to produce. So that would include things like gold, oil, beef. Um, those things over the long term have risen at a faster pace than CPI, but a slower pace than M2, but still kind of comparable. Like roughly, say M2 per capita is roughly what they tend to grow at. And then when you go down to the lower tier of like things that are barely scarce at all, plastic, toys, electronics, software, we've gotten way better at making those, and that's like the big deflationary tail that kind of lowers the overall CPI. So going back to the question, basically gold as something that historically only increases in supply by about 1.5% per year, it tends to do better than most other assets over the very long term when measured compared to broad money supply. So that usually tends to be a decent proxy for how well over a multi-decade period gold's going to do in a given currency. Shorter term, there's all sorts of factors that influence. Real interest rates are one of the big factors. There's been some interesting decoupling lately, but generally, normally if real interest rates are going up or down, that can very much affect the gold price. And so those tend to be kind of the two main variables I look at, which is basically how much is money supply increasing. So basically, what is overall liquidity doing? And then also how are perceptions around forward inflation adjusted interest rates doing? Because if you're in an environment where uncertainty is high, money supply growth is high, and real yields are expected to be low or negative, then gold becomes a lot more compelling to hold than cash equivalents. On the other hand, if you're in an environment where you expect slow money supply growth, you expect very positive real rates, then gold ends up having that negative carry compared to what is a relatively sound fiat currency situation in that type of environment. And so when I look over the longer term, I think we're because of how much debt's in the system, because of the structural deficits we find ourselves in, I think we're going to see even though right now we have a period of M2 contraction, we're already starting to see kind of a potential bottom in that process ever since roughly April. And I do think that we're going to continue a trend of ongoing M2 money supply growth, and that countries overall are going to kind of shift more towards gold in some of their central bank holdings. And I think basically it's an asset to own in the years ahead. And the fact that it's actually been pretty resilient against the rise in interest rates has been pretty interesting. Basically, the some of the geopolitical interest in it seems to be compensating for the fact that the Fed's like inflation and fighting hawkishness would otherwise be somewhat of a downer for gold.
Right. That's great insight there. And just carrying that further in terms of real yields, we are seeing bond yields rising again, and again, perhaps maybe we're seeing a reacceleration of inflation. But ultimately, if we do eventually get this recession in the U.S. and we do see longer term yields go down, will that be one of the factors, along with all the other factors that affect gold that send it solidly higher?
So I think there's two types of environments that gold would very benefit from. One would be kind of the runaway inflation scenario. So that's where gold gets its reputation as an inflation hedge. So if you see countries like Argentina, Lebanon, they have very bad currency problems. Gold is a safe haven for them, protects them against all that. And then in developed countries, when you look at the United States in the 70s, for example, gold did very well during an inflationary high rate decade because there's this long period where the Federal Reserve had a lot of trouble getting that inflation reliably under control. And so if the market perceives that inflation and rates are rising, but that inflation is not controlled, then gold would do well. On the other hand, where gold would do well is the scenario you just pointed out, which is generally decelerating growth, decelerating inflation, and then yields that are falling even faster than inflation expectation, and therefore falling real yield expectations. That'd be another decent environment for gold. And a good comparison there is basically the bull market of 2019, where the economy was rolling over, it was decelerating, not in a recession yet, but just decelerating, and gold did quite well. The environment where gold tends to struggle is kind of the scenario between those two, where the market says the economy's still kind of hot, inflation's still kind of hot, and but the Fed has full control of it. They're going to get more hawkish, and therefore real yields are going to rise. That's the market environment that we're still kind of dancing around. That's been, I think, preventing gold from breaking out. I eventually think we're going to break to one of those side scenarios that benefits gold more than it has been in recent months.
Right, and we'll see how that all plays out in the next 6, 12 months or so. Last question for you, Lyn. On your website, which provides all sorts of great free research from you, along with your premium service as well. But you mentioned 20 safe high dividend stocks, and I noticed that 4 of them are gold related: Agnico, Franco, Royal Gold, and Barrick. You mentioned the royalty model being appealing. You mentioned good management teams. Can you elaborate on, without going into a great deal on all 4, but why are those 4 in that group of 20?
Yeah, so in general, that portfolio focuses on non-gold type of stocks. But I felt for diversification's sake, it's useful to have some gold equities in there as well, even though they don't generally fit the description of a higher yield stock. They're generally lower yielding, but it's a nice hedge. And in general, when you look at it over the long term, it's unfortunate because gold miners do very poorly generally compared to gold. Um, and what you'll get is kind of the normal fact that like there's a small percentage of gold miners that just do outrageously good. They make all the right decisions through the cycle. They manage themselves well, and they outperform gold. The long tail, the vast majority of miners tend to underperform gold. And historically, the gold royalty business has generally been in the outperforming category because it's just an inherently better business model. And so you generally get a lot of the upsides of gold, but while minimizing a lot of the downside operational risks. Now, of course, there's a cost to that. You end up paying a much higher valuation for a royalty company than you pay for a miner. But the metrics, like how much revenue they get per employee, what are their gross margins? These tend to justify very high valuations because you're kind of comparing them to like almost like software as a service type of companies. Basically, the types of attractive business models that can warrant fairly high valuations on them because of their perceived safety, their perceived reliability. So I do think that for people that are interested in the precious metal space, in addition to just owning precious metals, I do think the royalty ones have to be considered. Kind of as part of a more conservative type portfolio before you start venturing out into the riskier area of say small cap miners that a lot of people I think are attracted to because they really like the explosive growth potential, but you have to be careful about position sizing because a lot of those do very poorly over the long term, and whereas the safer things tend to actually have better longer term performance.
Lyn, fascinating insight at all, as always. Thank you so much for joining us today. We appreciate it. We'll see you again.
Thank you for having me.
Okay, Lyn Alden. She's the founder of Lyn Alden Investment Strategy. Thanks for watching, and we'll talk to you next time.